Well, hello. This video is designed to explain the annual financial audit and the important role of counsel. Not all audits are created alike. For example, there are internal audits and compliance audits, tax audits, forensic audits, financial audits, and others. And this video is all about financial audits. Attached to the audited financial statements is the independent auditor's report, and in it explains the auditor's responsibilities. The primary objective is to obtain reasonable assurance that the financial statements are free from material misstatement. In law and in accounting, materiality is the term used to describe the significance of information to decision makers. In plain speak, something is material if it would or could influence a decision. And even though the auditor does set a dollar threshold, there's no one universal dollar amount. Materiality for not-for-profit is usually a percentage of revenue or expenses. And the auditor is going to explain all of this to you when they present the audit. But it's important to remember that materiality refers to anything of significance, not just dollar amounts. That's why there are so many notes to the financial statements. The auditor's responsibility is to obtain reasonable assurance, not an absolute certainty. Oh, it's a high level of assurance, but it's not a guarantee. Auditors use professional judgment. That's just regular judgment with a big helping of specific training and experience. They approach the task with professional skepticism. They can't simply accept management's assertions that everything is okay. And while the auditor does assess the risk of material misstatement, it is important that you note that the risk of not detecting a material misstatement resulting from fraud is higher than one resulting from error. I think that makes sense, although many people are surprised. But by the very nature, fraudulent activities are designed to avoid detection. Now, if the auditor was to detect fraud, well, fraudulent activity is always material, and of course it would be reported to you, even if it was a small amount. Keep in mind that the financial audit is not designed to detect fraud. That's the work of a specialist, a forensic auditor. In order to obtain reasonable assurance that the financial statements are free from material misstatement, the auditor uses standard auditing procedures. And the first one is to simply ask questions. The auditor wants to assess the risk, and so they start by looking at day-to-day operations, the controls and procedures. They want to see if staff are well trained and follow the processes. They look at CRTO as a whole. Risk of financial misstatement is reduced when there is effective governance, and that includes counsel. An engaged counsel with sufficient diversity of experience, one that takes an active interest in finances, a counsel that understands and executes their role in monitoring finances. These factors reduce the risk that there's anything wrong. The auditor wants to ensure that policies are clearly approved, documented, communicated, and followed. And the auditor wants to be aware of the regulatory environment and statutory requirements. So we go back to procedures. Once the auditor has a good understanding of the entity and its risk environment, they then plan the audit. The auditor observes processes and procedures. They check the mathematical accuracy of key documents, estimates, and allocations. They ensure that some things really exist, whether it's a piece of equipment, an invoice, or a policy. They seek external confirmation. The most common one is to ask the bank or financial institution to confirm bank balances, investments, any outstanding debt. And they use analytical procedures like trend analysis, ratio analysis, and comparisons. Once the work is complete, the auditor provides a report that says, In our opinion, the accompanying financial statements present fairly in all material respects. If an auditor was unable to obtain sufficient audit evidence, then they would issue a disclaimer. And here the statements might be fine, or not. The auditor just couldn't find enough evidence to support an opinion. It could indicate the controls are weak, that accounting records are incomplete, or lack sufficient rigor. The auditor is basically saying, I don't know. In the very rare event that the auditor did obtain sufficient evidence, but came to the conclusion that the statements do not present fairly, they would issue an adverse opinion. So you can see now why it's really important that you read the opinion paragraph of the audit report. Most likely the audit report will be clear or unqualified, like the one you see here. However, CRTO's annual report includes summary financial statements, and the auditor has expressed an opinion on these as well, but now it's a qualified opinion. Note it says accept. And the opinion tells you why the summary financial statements are not in complete accordance with the Canadian accounting standards for not-for-profit organizations. The summary statements don't include the changes in net assets and cash flows, and as well the notes are not provided. So that's what the auditor does, and doesn't do. What about you? Well, specifically, Council approves the retention or selection of the auditors. And you review the audit plan and you approve the fee. You review the auditor's performance. And the auditor must maintain independence, and you must be satisfied that independence is actually maintained. And you need to review the quality of management's assistance. Now, to do all of this, the audit committee, they must meet privately with the auditor. I know that some people feel that an in-camera meeting with the auditor must indicate that you don't trust the CEO. But nothing is further from the truth. It is simply a requirement in good governance. By providing space for open, frank questions and concerns, trust is strengthened. You need to satisfy yourself that the financial side of CRTO is well managed. The audited financial statements then are primarily a communication tool. They provide interested readers a picture of the financial position and operations of CRTO. The summary statements are included in the annual report along with other information of interest to readers, and you want to make sure that the information is accurate, reliable. You know, when you're looking at the financial statements, they shouldn't come as a surprise to you since you've been looking at interim financial statements at each meeting. So make sure you take a look, just to make sure that nothing surprises you. You'll see on the balance sheet and on the statement of operations references to the notes. The notes provide additional information. And you should review the notes. Okay, you don't have to read them in painful detail, but you might find them interesting, and they can help you better understand the business side of CRTO. It's all right to ask questions. And let me rephrase that. It's important to ask questions of management and of the auditors. It's how you fulfill your legal requirements. You have two primary duties. One is a duty of loyalty, and the other is the duty of care. In order to carry out your duties with care and diligence, you need to take the time necessary to make informed decisions. And you need to ensure that you have adequate information. That probably means you'll have to ask questions. Remember, council, not staff, council appoints the auditor, and the auditor reports to council. I hope this provided sufficient information so that you feel more comfortable reviewing and approving the audit. Thank you for your interest. And remember, stay curious, be brave, and speak up.